Hello and welcome to another episode on my YouTube finance channel. In today's episode we're going to be talking about dollar cost averaging, and this is an investment strategy that I believe that 95% of the population should be using for their main investment strategy to help them accumulate wealth over time. And really it's just a proven investment strategy and method that has, like I said, been proven to work and proven to provide people the ability to accumulate wealth. So the stock market can be a volatile and unpredictable place. As you can see by these graphs, there's times where the stock market can continue to go up, but there are also times where the stock market can drastically decline extremely quick, and people don't know what to do in those times, or can make emotional decisions. So what if there was a method that I could introduce to you guys that lowers your risk and also lowers the chances of you making an emotional decision that is going to impact you long term? So enter dollar cost averaging. So as you can see by this graph of the S&P 500, back in 1983 it was at $147.65 per share, and now as of February 3rd in 2023, the S&P 500 is all the way up at $4,137. This is a 2,701% incline or gain over time. As you can see in this graph, there's times where it's going up, there's times where it's going down, periods where it's declining extremely quickly. And moving to the next graph, this is over the last 5 years. So back on February 9th of 2018, the S&P 500 was at $2,619 dollars, and now as of February 3rd, 2023, it is up to $4,137. So this is a 57.9% return over the last 5 years. So now, where do these graphs come in with dollar cost averaging, and what exactly is dollar cost averaging? So dollar cost averaging is a strategy where you're going to invest a certain amount of dollars at a fixed interval. So for example, you could invest $100 once every month, you could do it once every 2 weeks, once every week. For me personally, I invest a certain amount of dollars once every week. So every Monday, that money hits my investment account, and I take that money and I invest it into the certain stocks and ETFs that I have decided that I want to invest in. If you want to hear about what those ETFs are and what stocks I invest in weekly, make sure you leave that in the comment section down below, and I can make some videos on those certain ETFs, those stocks, and maybe show you guys some different places that you can invest your money in. So one of the nice things about dollar cost averaging is that you're going to get the benefit of buying more shares of stock when the prices are going down, like a recession at this moment 2022 was, and people are saying 2023 was. You're also going to be buying less shares of the certain stock or ETF when the prices are going up. So what this does is it allows you to get an average, hence dollar cost averaging, get an average of the price per share that you're buying of the certain ETF or the stock. So when the prices are going down, it gives you the benefit of buying more shares, so that when the price goes back up, you're going to reap the benefits of all the return on that extra amount of shares that you have because of dollar cost averaging, rather than just investing a lump sum of money. So now looking at this graph that's showing the difference between investing a lump sum versus dollar cost averaging, as you can see that investing a lump sum all at once can be risky. If the markets take a downturn shortly after you invest, you'll likely lose money. So in this graph you can see that from 2006, if you invested that lump sum all the way up until halfway through 2008, you're going to actually be losing money with that lump sum investment. Whereas if you were dollar cost averaging, like I said, you're going to be getting the benefit of buying more shares when the prices are going down. So that way, once the prices go back up, you are going to be reaping all those benefits, all those gains for the more shares that you bought when the prices are going down. And this ETF is only showing if you're buying $50 monthly. I like to do weekly because that really lowers your risk even more and allows you to average out the price per share that you're buying even more by going weekly. So if I were to give any recommendations, I would say to do it weekly instead of doing it monthly. But as you can see in this graph, throughout the 10-year period here, the dollar cost averaging method does equate to more money in the long run. And if you do this over a 25, 30, 40-year period, you're going to get even more of those benefits. So another key element to dollar cost averaging is that it really removes any of the emotional decisions that a person could make. For example, in 2022, or during COVID in 2020 when the prices were continuously going down or took a sharp decrease. A lot of people made emotional decisions and decided to sell their positions or liquidate their positions in certain ETFs and stocks because they were worried about all the money they were losing in the short term. But when you have the dollar cost averaging method and you stick to it, really you're viewing long term. You're thinking long term gains, just continually getting the average and reaping the benefits when it goes up over the long term. So with this method and the DCA method, it really removes the emotional decisions that you can make to quickly sell because you're not worried about the price going down. If you truly believe in this ETF or this stock and you think it's going to go up over the long term, you're actually going to be happy about the prices going down because it's allowing you to buy more shares with that same amount of money so that when the price goes back up in a year, 2 years, whenever this downturn or recession is done, you're going to come out ahead more than people that made the rational or emotional decision to sell all their positions because they're afraid of losing money in the short term. So with dollar cost averaging, you really want to have that long-term mindset. Come up with a plan of how much money you're going to invest, each week, every 2 weeks, each month, whatever your method is or whatever plan you want to follow. Stick to that plan and think long-term. So looking at this graph right now that's up on the screen, you can see that dollar cost averaging will return you, a better percentage return on your investment, over the long run. So in this one, if you're investing $1,000 monthly versus $8,000 at one time, over the 8 months, you're going to see a 4.07% return compared to if you did one lump sum investment, you're going to get a 0% return. And that's because at the beginning when the price goes up, you're buying shares as it gets up to $14 a share, but when it's coming down, you're going to be buying shares when it gets all the way down to 9, then when it's down to 8, down to 7.5. So as the price goes down, you're going to be actually buying more shares of that stock or that ETF, which in turn, when the price goes back up, you're going to see more gains, reap more of the benefits, and actually get a higher return on your investment. So as you can see, dollar cost averaging is a great method for investing. It's a really kind of foolproof strategy that you can put to work for yourself and reaching your financial goals. It's one that minimizes risks, it maximizes returns, and it also removes the emotional element out of investing. So in my opinion, for 99% of the population, dollar cost averaging is the way to go if you have a long-term mindset and a long-term horizon. So if you're like myself, you're 23, almost 24 years old, and you have 35, 30, 40 plus years ahead of you to continue investing to accumulate wealth, dollar cost averaging is the way to go. Rather than to invest one lump sum, save up money, save for a year, 2 years, then invest more of a lump sum. Just continue to dollar cost average. Keep buying those shares when the prices are down and accumulating more shares. Keep buying when the price is going up. If it's an ETF, if it's a stock, individual company that you truly believe in, dollar cost averaging is the way to go. So I hope you guys enjoyed this video. I hope I was able to teach you guys some things, show you a strategy of investing that has been proven to work, and I think that the majority of people should be using as their main investment strategy. If you liked the video, make sure you hit the like button. Subscribe to the channel. I'll be putting out more finance videos every single week. So hit that like button, hit the subscribe button, and we'll see you guys in the next video.